Hello and welcome to a stock analysis blitz for Smith Nephew. Smith Nephew are a FTSE 100 listed medical devices manufacturer, currently paying about a 2.5% dividend yield. Thanks to Botanics B for suggesting I take a look at them. Before I start, please remember that I do these videos just for fun as a hobby, and always speak to a qualified professional financial advisor before making any investment decisions. So Smith and Nephew have three main areas that they make money in. One is orthopedics, the other is sport medicine and ear, nose and throat devices, and the other is in advanced wound management. So when you look at the front cover of their last annual report, you see that obviously a lot of their products are aimed at elderly people. And actually, this is a segment of the economy that's of great interest to me. It's one of my investment ideas at the moment. You see that actually most of the wealth of society is owned by people aged 60 and older. And this is actually the baby boomer generation, which really has captured enormous amounts of wealth. And obviously, because of modern science, people are just living longer and longer. So targeting the massive riches of the baby boomers is certainly a investment idea of mine at the moment. So when I look at their website, we see orthopedics is obviously that's 41% of their revenues. And this is of course hip replacements, actual whole knee joints here, which really do look expensive. And then actual whole bits of bone that can be replaced. I mean, presumably that's for a leg bone. Then they do sports medicine and ear, nose, and throat. And you can see here some kind of knee ligament surgery device. And obviously, this all looks very expensive and very specialist. And here is what, well, you could imagine what ear, nose, and throat devices would look like. So, very technical, high end devices. And then the advanced wound management, no idea what that is, but I think special magic plasters. And when we look at the revenue by geography, it's about 54% in the US, with 30% in other established countries, but then only 16% in emerging markets. Now, when I look at their net income history, though, it is actually fairly disappointing. We see, in fact, a narrowing between their income and their expenditure, and their net income looking very poor. And within each of those different product classes I just went through, they're actually much of a muchness, and there's no one particular area where we see good growth. So their actual revenues profile looks rather stagnant, and it isn't growing. And I wonder if they started off with the orthopedics, and then they kind of grew by acquisition, by just buying other companies to try and grow by acquisition. But they certainly look kind of stagnant, really, as a company at first glance. So, looking at their news flow, and their chief financial officer left in 2020, they bought a orthopedics business for 240 million in 2020. So that then helps build my little theory there that they've just been growing by other people. They've just been growing their revenue by just buying out other people. They are obviously their CFO had left, and then their CEO left, and then their CEO left in 2022, and they got this new CEO, and of course he came in and announced this 12-point plan. So back to their 2022 annual report, and reading through this, the general impression I got, or the general vibes I got, was that they weren't really doing very well, but their new CEO was making out that he was going to improve everything. So they got a new chairman as well. So obviously you can always take it either way with all these changes, but generally the bulk of cases, when you see this magical chairs of CEOs and CFOs and chairmen coming in and out, it generally just isn't a good thing. I'd much rather invest in a company that's kind of got a established leadership and a good track record than one where it's all chopping and changing, and you've kind of then got you're then kind of left with this feeling of uncertainty. And then they've just released their Q1 update for 2023. And in this, they said that their Q1 revenues were up 7%, but that although their established market revenues were up, their emerging markets was down 7%. And they mainly blame that on China, where they're doing this volume-based procurement thing. And if Smith and Wesson's hopes for future growth lay in places like China, that really does concern me actually as well as an investor. So generally, though, in terms of the raw numbers, this quarterly update, wasn't particularly inspiring. And the main problem is, as I already highlighted, is they've got a real kind of problem where they're just stagnating as a company in terms of their product sales across all segments. You can't see growth coming from any one particular segment, and their best hope here would be for growth in the emerging markets, and that hasn't happened according to the Q1 update. Looking at their numbers, and for sure they are bringing in a lot of money in terms of their revenues of 5 billion a year, and they are kind of steady revenues actually overall. But of course, we see that their net income trend is only reducing, and as actually really was quite bad. When I've drilled into the numbers a bit, we see that actually the reason for it being quite bad in 2022 was this loss from share of associates, and that's because they own a 28% stake in this company by Ventus, and so whenever the value of that stock gets upgraded or downgraded, that then causes these rather noisy fluctuations in their expenditure, because it's taken as a loss when these impairments happen on a year-to-year basis. And so that puts you in this uncomfortable situation of having a bit of noise that kind of disguises a bit how they're really doing. But still, that explains this measly result for 2022. But even if you credited them that 141 million, they're still well below the lower end of the range of their net incomes historically. And so there's no clear path to them increasing their net incomes from these kind of lower numbers they're getting down here. So they're making a lot of money in terms of their gross revenues, but 5 billion is a lot of money, and maybe these particular markets they move in have been expanding a lot over many decades, but now really have met a kind of saturation point. And of course, you don't know what, and of course, there must be quite a lot of competition as well in these areas. And half their assets are goodwill, with roughly a quarter being all their capex they have for all their high-tech manufacturing plants, and also their intangible assets. So obviously they've got, I guess this is kind of what you'd expect a high-tech producer like Smith and Nephew. They have the IP, which is worth a lot, and they have a fairly reasonable expectation of selling that product over a number of years based on that IP, which kind of explains these assets and how such a large amount of those assets are intangibles and goodwill. And it's actually quite interesting that they have about 2 billion of inventory assets, current assets, which is obviously the things like the knee implants, whatever they've made, but they're yet to sell, and over 1 billion in trade receivables. So that's hip replacements that they've sold, and they're still waiting for the people to pay them for that. In terms of the debt, and really, it's in the short term, it's good to see that the short-term debt is quite outweighed by the current assets. Most of that short-term debt is just trade payables, and in terms of their long-term debt, that's dominated just by bank debt. So they have 3 billion of debt, and actually that's quite a large number and a bit disappointing for a established tech company like Smith and Nephew. That is a little bit disappointing that they've still got about 3 billion in debt. But overall, their accounts look fairly clean. The particular signature we see here is really just tells you more what kind of company it is, a high-tech manufacturing company, than anything else. And it's a fairly steady signature. There's not anything particularly standing out that I have to go in and focus on. That really does, again, build into my concept here that they really are a company that's gone through its growth phase and is now in a kind of stagnation phase. And a bit of a shame about the debt there. So we saw that obviously they had a dip in sales, but then because during COVID, all the hospitals were closed, so no one could go in for a hip replacement. But then we've had obviously in 2021 a bump of the hospitals then catching up on that backlog. So that explains why their growth and net income growth did that dive in 2020, then rebounded in 2021. However, then when we look at the more normalized 2019 and 2022 numbers, it's a fairly stagnant growth story again, barely above 1.0 growth, and their net income looks pretty bad. So here we see their market cap, and you can quite clearly see how their net income really is a tiny fraction of their market cap. And so for a company that seems to have gone through its growth phase and is now looking a bit stagnant, that's quite a horrendous overhang. The debt there doesn't look good. What I've done is I thought about, well, what about their future sales? And let's say they really pull it out of the hat and achieve 1 billion sales a year for the next 5 years and forget about inflation as well. That's obviously an incredible, giving them a big favour if we were to assume that. But even then, if I was to outlay those numbers here against their market cap, they still do look rather overvalued. So yeah, they definitely don't look cheap. Just the superficial stuff I've seen, this company really does look, it's just a story of stagnation. They've got these sales that seem to have stagnated and they really don't look cheap either. So it's quite easy for me to not spend any more time with them and not even bothered to put them on all of my watch lists. They are a company that targets the grey market. If you wanted to keep an eye on such companies, and I guess they do at least have fairly assured revenues in the future. But given their lack of sales growth, you do wonder if what's the kind of competition like there. But yeah, I certainly don't see any reason why I'd be interested in investing in this company. So I hope you've enjoyed this video and keep safe. Please read the disclaimer. Remember that prices can go down as well as up.